On today's Hot Sheet, I'm discussing Zillow's November market report, Macy's real estate portfolio, and the latest CPI data released this morning. Today is Tuesday, December 12th, 2023. I am Byron Lazine, and the Hot Sheet starts now. Okay, kind of a big day today as we have some CPI data, which we will cover at the end of the stream here. Let me know in the live chat which market you are tuning in from. We also have today marking the start of, or actually, I believe is it today? Yeah, it is today. It's marking the start of the FOMC meeting today and tomorrow, 2-day meeting for the FOMC. Jerome Powell and the Fed will meet. And Wednesday afternoon, tomorrow afternoon, we will hear from Jerome Powell, and we'll break that all down on Thursday, as we always do. But before all that, let's jump into Zillow's November 2023 market report. Zillow claims that buyers are finding a bit of relief as prices and rates ease. Okay, so here's what Zillow believes buyers should know about the market right now and what potential sellers should be keeping in mind. Okay, here are the 3 bullet points. For buyers, lower mortgage rates and cooling home values made a home purchase slightly more affordable in November. So welcome sign for all buyers. Price cuts are more common than normal. Chances are good that prices are negotiable. So price cuts are more common than normal per Zillow. More normal if you go back on a 10-year run, but price cuts are less likely than this time last year. Remember, we went over this yesterday with Altos Research, where last year we were running at 42%. This time of year, this year we're running at 38% of listings will do a price cut. Higher than normal, yes. Lower than this time last year, though. Okay, while choices are still scarce compared to pre-pandemic norms, the inventory deficit is shrinking. We are seeing that, albeit very small numbers. What potential sellers should keep in mind: competition for attractive listings is still hotter than normal in the low inventory environment. Homes are selling 2 weeks faster than the pre-pandemic. So go back to 2019, and homes are still selling 2 weeks faster than that time frame. And that was a good market. For those that were in 2019, that was a pretty good market to be a seller in. Mortgage rates are slowly easing down, but buyers are still constrained by cost. Dropping your price to meet buyers where they're at is a common strategy, more so than typical at this time of the year, depending on price point, location, etc., as we all know and understand in our local markets. All right, so let's look at some more of the market trends per Zillow's report. Monthly costs for a new mortgage are fallen, driven by that decline that we've been experiencing. Rates are still above 7%, which are impacting demand and are pushing home values down. I'd argue that the seasonality of the market is what is dampening values right now, because we hit all-time highs on values leading into 8%. So to make the case that rates are pushing values down, we hit all-time highs this year during the peak of the season, and we may very well do that next year. Now, Zillow on their projection doesn't have that being the case. Zillow has the projection of a price appreciation being flat in 2024. That's down from just a couple months ago being at 6.6% positive on price appreciation. But to say that right now, the decline that the mortgage rates are pushing home values down, I don't think tells the whole story, because as rates were going up higher than they even are today during season, we hit all-time highs. Some sellers are returning to the market, according to Zillow, contributing to a decrease in the new listing shortfall from 35% below pre-pandemic norms to 14%. Okay, let's look at month over month. Home values rose in only 2 of the 50 largest U.S. metro areas month over month. That'd be Miami at 0.3% and Las Vegas at 0.1%. The largest drops in home values month over month were New Orleans, 1.6%. Talked about them a bunch Yesterday, for other reasons, Austin negative 1.3%, San Antonio minus 1%, Minneapolis minus 1%, and San Francisco negative 0.8%. So month over month, the only two gainers being Miami and Las Vegas. Not surprising to me to see fewer month over month, or very few month over month gains right now. We're again in the seasonal time frame when you typically would see. Just look at this chart from Zillow, right? Going all the way back to 2019, right? This time of year is when on any given year you're going to see these seasonal declines that happen in price. It's why if you're a buyer in the winter months, during this time of year, during the holiday time of year, if there's inventory that's attractive to you, you can likely find a better deal now than you could when there's more competition, which would be, starting up in February and in March and in April when there's the majority of the buyers in the market. This chart here, different highs and different lows for every individual market. You could pull data out of your MLS or somewhere else from your local market, and it's going to look like this 99.9% of the time. There's going to be peaks on that given year, and there's going to be valleys, and those valleys are, set your watch to it, typically always in the winter in almost every single market. This holiday season, when people will withdraw from the market, and you will have just, essentially serious sellers in the market that need to sell, and serious buyers obviously that need to buy, and they need to come together and make a deal on a certain timeline, and that can impact the pricing here. So looking at, if we look at 2019, look at where that high is. That high is in June. Okay. If we look 2020, it was a little later that year, but September. 21 was May. Last year, 22, happened to be in April. April here in 2023. But the bottoms are going to be typically, there you go, December, January. 21 happened to be September, but you can see pretty close there in December, and December for 2022. And what do you know? Here we are on the downside. We're November 2023, but you would imagine December will go a tick lower. So you can set your watch to this. Zillow's own chart tells that story of seasonality. And if you went back actually 10 or 15 years, which Zillow's chart is not doing here, if you went back maybe in your MLS 10 or 15 years and did that month over month chart that we're looking at, you would actually see more consistency on what I'm talking about. Where if you go 2012 to 19, those 7 years, you will see consistency of the bottom of the market. December, maybe a January in there, but it's going to be December very consistently almost every single year on prices. So that's my take on where on price appreciation on home prices not being pushed down right now by mortgages. In fact, we've seen mortgage demand go up the last 3 or 4 weeks, according to Mortgage Banker Association, but being pushed down due to the seasonality of the market, in which we always see home prices come down this time of year. Here's Zillow's outlook on, or not outlook, reporting on the home value for going all the way back pre-2004. And here's that record that I'm talking about being set this year, the higher peak above last year. But we saw this season out, not only seasonal drop, but a drop that reacted to the rates last year in 2022. We'll see if we go as low on our seasonal winter timeframe this year as we did last year as the next few months play out. But so far, with New Orleans coming in at negative 1.6 month over month, New Orleans being one of the areas that is just being impacted the most across the board. You have a higher delinquencies or you have higher. I'm sorry. The report we had yesterday was you have a higher percentage of underwater homes in New Orleans than anywhere else. It was also projected beginning of the year to be one of those markets that lost values more than anyone else. But being at 1.6 month over month, and then Austin 1.3, San Antonio 1, um, we're not. There's not a cliff here happening in any of these markets. Okay, home values are higher than last year, though. When we go year over year, in 37 of the largest 50 metro areas, that's what I'm talking about with the record peaks that were set this year. Annual home appreciation is strongest in Hartford at 11.3%, Milwaukee at 8.5%, San Diego at 7.6%, Providence at 7.4%, and Boston at 7.2%. Those are huge gains on annual year over year home value appreciation. The largest value drops year over year were in New Orleans, 8.9, Austin, 8.2 negative, San Antonio down 3%, Jacksonville down 1.5%, and Memphis down 0.9%. So you see New Orleans and Austin are really leading the charge on home values that are dropping. Inventory trends, new listings improving, down only 14% from pre-pandemic levels compared to a 34.8% shortfall in April. So gradually chipping away, week by week at this inventory crisis. Total inventory decreased by 5.3% from October, 2% lower than last year, and 37.2% lower than pre-pandemic levels. Asking rents across the U.S. decreased by 0.2% in November, following seasonal norms. That number will play into our CPI report as we're going to look at shelter there in just a bit. Typical U.S. rent. Zillow has up 3.3% from last year. There's been a lot of reports that show it down a percent. So Zillow's got typical U.S. rent up 3.3% year over year. That would support what I've been saying is, too high, that shelter CPI. That would support the year over year increase, although shelter on CPI is much higher than 3.3% year over year. Rent growth is stronger for single family homes than multifamily homes, 4.8 versus 2.5. All right, there's your Zillow report on November. Let's take a look at a very seasonal brand, which would be Macy's and their real estate portfolio. Macy's, for many of us that grew up going to big, large shopping malls, Macy's was always one of those anchor stores in almost every mall in America. Well, now Macy's is in a different situation. They have a buyout proposal on the table from Ark House Management and Brigade Capital Management. They submitted a buyout proposal for Macy's for the entire brand and company valued at $5.8 billion on December 1st. This has led to a surge in Macy's shares. Macy's, when they made the offer, had a value of $17 per share, and this offer of $5.8 billion reflects $21 per share. So typically, when you see that, you will have a rally in the stocks, and that's what this report in the Wall Street Journal is referring to. Now, Ark House Management, which is one of the buyers here, along with Brigade, is known for real estate investments specifically. Brigade Capital is more retail focused, so there's a good partnership there. They're more interested in Macy's Ark House for the real estate holdings. Macy's owns more than 300 of its 783 stores as of January, with an additional lease locations and mixed ownership. Now, listen to this. This is for real estate folks. This is really interesting. I think it validates how valuable real estate is and what we do. Analysts estimate the value of Macy's real estate to be around $6 billion. Wait a minute. Analysts are saying the real estate is worth 300 of its 783 stores being owned. The real estate is worth $6 billion, but the buyout proposal is $5.8 billion. If they didn't own any real estate, essentially what I'm reading here is that there would be no offer for Macy's. They'd be worth $0 if there was no offer, if there was no real estate being owned. And so for businesses that Macy's probably still has some brand equity, and I know they tried to reposition their brand to go into, um, some more of the, not the freestanding malls, but more of the chain, commercial, strip mall type of, locations. They tried to make that pivot about a year ago, and so there's probably still brand equity on Macy's, whether it's, online or doing something like that, like think of Kohl's or, a Saks Fifth Ave that's, in some of these freestanding, strip malls as opposed to anchoring a mall. It shows you how much the real estate is actually the value in a lot of businesses. And, for the businesses that are only always leasing their office space, there's at the end of the road. I mean, a lot of think an insurance business or real estate businesses. When you own the building, it can be a great forced savings and appreciation plan for that business owner at time of retirement. If you're going to have an office or a commercial space for 10, 20, 30 years, the value in owning it is it's invaluable. I mean, just look at the McDonald's movie Founder, right? That whole business was built on owning the real estate, not necessarily, or the value, anyways. The real equity and exit in that business was based off of the real estate, not necessarily, um, the burgers. Okay. So just, I thought that was interesting. Let's jump right into, what I find the most interesting every 45 or 30 days or so when we get one of these reports, and that's November 2023's Consumer Price Index report, CPI data. This shares a 1 month, and a 12-month change in CPI. Also has additional details on food, energy, shelter, and other categories. All right, so let's break this down. And I love to go to the first page, as always, on the news release Bureau of Labor Statistics, U.S. Department of Labor, which releases this every single month. Today, being December the 12th, it was released at 8:30 a.m. Now it was the release was embargoed until 8:30 a.m. I'm assuming with the FOMC meeting today, with Jerome Powell and the Fed meeting today, they probably got this release earlier because they're going to take this into consideration. Usually in the second line, they always lead off with what seems to be the same line almost every month lately. The index for shelter continued to rise in November, offsetting a decline in the gasoline index. Energy, because gasoline came down here, over the last month, is what they're talking about. So, shelter continues to be one of those major drivers, or the major driver on CPI. If we go down here to the next paragraph, the index for all items less food and energy, basically that's called core CPI. Okay, so all items less food and energy would be core CPI. When you include food and energy, you just have the CPI, the consumer price index. So core CPI, which rose 0.3% in November after rising 0.2% in October. The index for apparel, household furnishings, or I'm sorry, indexes which increased in November include rent, owner's equivalent rent, medical care, and motor vehicle insurance. That owner's equivalent rent is the one that I have a major problem with. We've gone back, over time over this year, and looked at the Wall Street Journal article, that talks about owner's equivalent rent, talks about other countries that don't use owner's equivalent rent. If in fact we didn't use owner's equivalent rent, which is a made up number, it's a survey, that was done in started in the 80s, where you call, somebody at their home and say, "Hey, what would your home rent for? If you had to go rent that same home, what would it rent for?" So this is a made up number. It's not a real number. It's not data from CoStar or from, apartments.com. It's not data from Zillow or anywhere else that you would go and access data from today if you were really interested in learning about where rents are heading. It is a made up number that people provide over the phone. And so, I've got a real problem with that, because why don't we just use real time accurate data? Technology and our ability to, source this data has grown significantly since then. But again, we're pointing towards owner's equivalent rent as one of the drivers leading up this CPI number. All right. So top line numbers for you. The CPI for all urban consumers, CPI dash U, did increase 0.1% in November. This is following, if you remember back to October, we were flat. There was no increase. What did analysts want? What did investors want? We wanted another flat reading. We got a 0.1% tick up, though, as opposed to a flat. Over the last 12 months, the all items index increased 3.1%. That's before seasonal adjustment. Last month we were at 3.2, so that did come down, but that met expectations. So expectations were, okay, we'd be flat again month over month. That didn't happen. We were up 0.1. Expectations were that when you look over the last 12 months, we would be at 3.1, down from 3.2. That did happen. So a little bit stingy here. A little bit, yeah, a little stingy is inflation, I guess, is what I'm trying to say. It's not coming down as much as we'd like it to. The index for shelter, but let me back up there. Not coming down as much as we'd like it to, but this isn't a catastrophic report. This isn't going to get the Fed to flip here on their meeting today and tomorrow and go and increase the federal interest rate. That hasn't changed. Investors are still 95+% confident that there will be no increase over the next couple of days during that FOMC meeting. The index for shelter, again, continued to rise in November. And let's go into take a look at shelter here. I'll bring up the actual report. This is when they do these CPI reports, we're talking about 38 pages of data. So we've got our show notes obviously available for you. So if you're a BAMX member and you want the show notes, here's basically you're looking at what's most important out of that 38 pages right here as it pertains to overall CPI, as well as the shelters numbers and the owner's equivalent rent. So you'll have all of this as well as the other two topics laid out for you in BAMX if you're a member of BAMX. If you're not a member of BAMX, you can use code HOT to get 10% off. Okay, taking a look now at shelter and we'll just run through the months here. May, shelter went up 0.6. June, it went up 0.4. July 0.4, August 0.3. Started to see a downtrend there. We're like, okay, here we go. But then September popped to 0.6. October down to 0.3. Now November back up to 0.4. Unadjusted 12 months for shelter, up 6.5% for shelter overall. Taking a deeper look now, I'll flip over to where we actually see owner's equivalent rent, and we'll take a look at that here on the table. Owner's equivalent rent, which makes up, I mean, this is how egregious this is. Owner's equivalent rent. It just jumped on me here. Let me find this again. My apologies. Here it is. Owner's equivalent rent of residences. This number here, this 25.825. I don't know. I guess I can't zoom in here. Won't let me zoom in. Anyways, the number is 25.825. Let me flip back to it. My iPad is being psychotic. All right, here we go. 25.825. That's the percent this made up survey, owner's equivalent rent, makes up of CPI. It makes up 25%. Shelter overall makes up 34.9% of the pie, of the meaning towards CPI. So rent of primary residence is only 7.6, okay, of that number, where the so shelter overall is that 34.9% of the pie. It's up 6.5% year over year, well above the 3 or 3.1 that we're at overall. Rent of primary residence is up 6.9% year over year. At how they measure inflation. I mean, the highest number I've seen on rent prices is that Zillow number at 3%. We know rents mostly, and there's other reports that have it down -1%. Rents have come down. They've decelerated dramatically over the last year. But this owner's equivalent of rent is up 6.7% year over year, and it's making up 25% of the puzzle. And there's some people, a Barry Sternlight from Starwood Capital, who controls billions and billions of dollars, who looks at this stuff every single day because he owns hundreds of thousands of rental units across the country. He points to this number all the time. Not enough people do point to it. He says you pull this number out, you've got inflation basically at the 2% Fed target. That's where, of course, Jerome Powell on this week, he's going to point towards that and say, "Hey, we got to get to 2%." Hopefully, he will say, um, hopefully he will say that we have seen deceleration because overall we have seen that. Jody, to do the show, how long does it take to prepare each morning for this show? The show notes are actually prepared by our senior editor here at BAM, Vanessa Bowman. You probably read some of her articles on nowbam.com. When we first started the show this year, when we launched in January, I was preparing all the show notes. Now, Vanessa and I have come to a formula that works where we're both, inputting topics in. She's preparing the actual notes, the notes that you receive. Her notes are much more organized than mine were, much easier to consume. But show preparation, every day takes about an hour to sometimes even an hour and a half for each show, each and every single day. So appreciate all of you guys that have been with us here this year on these shows. Make sure you hit subscribe and hit the bell. Thanks for the question, Jody. Nick T from Wall Street Journal had some charts up this morning. The core CPI, which was up 0.3% in November from October, that was in line with expectations. So core was in line where the CPI, the overall CPI, was the one that did slightly meet expectations. Core CPI, again, is if you take out food and energy. It's all goods and services there minus food and energy. So this held the 12-month core inflation rate at 4%. It brought the 6-month annualized rate down to 2.9% in November. That's down from 3.2% in October. So core on a 6-month, had a pretty big drop there. The 4% on the 12-month core inflation still obviously way too high as the Fed is fighting to get all these numbers down to 2. The consumer price index rose that 0.1 that we mentioned. That is what missed expectations, but the 3.1 on the 12-month inflation rate was what met expectations. The 6-month annualized rate is also holding at 3.1%. But you can see here in the charts that Nick T provided from Wall Street Journal that we have seen significant deceleration on inflation, but still a little bit too sticky. We'll see ultimately how the Fed will react to these numbers. Energy was again the biggest driver. The numbers would have been worse had it not been for the energy decline that we've seen here over the last 12 months. And you see here all items food, all items less food and energy, all up. Energy, the big driver, down. All right. What else are we rooting for to go down? We'd be rooting for that 10-year. Okay. What are investors as they consume this data here this morning, CPI, feeling about the market? The 10-year Treasury yield's a great indicator, and it's basically flat. We're sitting here at 4.240. Maybe just more wait and see to see what Jerome Powell says this coming tomorrow afternoon, and we'll break it all down here on Thursday's show. 30-year obviously follows the 10-year quite closely, and yesterday we remained essentially flat from where we ended the week on Friday, from at 7.09 on Friday up to 7.1 yesterday on the 30-year fixed. If we get any good signs from Jerome Powell, you could see these numbers potentially go down. We'll see how they react. Obviously, nobody knows, but we'll see how they react as the week closes out. One thing I thought that was interesting, this is just a survey, a CNBC Fed survey. They do this once a month, and it's 35 respondents that take the survey. They include economists, strategists, and analysts. This Fed survey that was just released this morning says that the Fed is going to start cutting rates middle of the year. I know that was a question yesterday, middle of the year in 2024, and the chance of a soft landing now, according to these economists on this survey, is high. Here's the forecast from the CNBC Fed survey for the federal interest rate. End of the year, so not drastic cuts. End of the year having us down about 3/4 of a point from where we are today. And then December 2025, another 3/4 of a point there. So maybe some slow cutting instead of rapid cuts, like they did rapid increases to the Fed rate. October forecast was 42% of a soft landing. Now, currently, the 35 respondents on this survey of economists and market leaders say it's 47% chance for a soft landing. Recession moving down 49 to 41. Those are big jumps in the way economists feel, based off of just a 30-day time period. These are pretty big swings. So you've got a large, a significant anyway percentage of these respondents swinging from recession to non-recession just 30 days later, based on some of the economic data that they have seen and considered here over the last 30 days. Okay, so there's the latest CNBC survey. We'll continue to monitor what's going on here with the economy and as it relates to housing, as we do each and every single day here on the Hot Sheet. Subscribe and hit the bell so you don't miss a Hot Sheet. And to get the show notes from every single one of our shows, as well as all of the daily downloads, which include the charts and all of the information here on every single show, make sure you're a BAMX member. Use code HOT to get 10% off of BAMX today. And I will see you back here. Actually, I'll see you on the live channel or on the main channel here, 2:00, with a Real Word podcast. And it's episode 300 that we're celebrating. So a little bit of a special podcast today. Episode 300 will be up on the channel at 2 p.m. All right, I'll see you back here, obviously, on the Hot Sheet tomorrow morning. Till then, toodaloo.